Valuation is the process of determining the present value of an asset, company, or investment. It is central to making informed decisions about investments, acquisitions, and financial strategies. Here are the key aspects. Valuation quantifies the worth of an asset or company, considering its financial performance, market conditions, growth prospects, and risks. The result is used to assess whether an investment is overvalued, undervalued, or fairly priced. Investment decisions. Determine if a stock, bond, or real estate is a good buy or sell. Corporate transactions. Valuing companies for mergers, acquisitions, IPOs, or divestitures. Financial reporting. Estimating fair values for accounting and regulatory purposes. Litigation or disputes, used in legal cases like shareholder disputes or divorce settlements. Strategic planning, assessing business growth potential and funding needs. Intrinsic valuation, based on the fundamental value of the asset using cash flows, earnings, or dividends. Examples: discounted cash flow, or DCF, estimates the present value of future cash flows. Dividend discount model, or DDM, values a company based on expected dividend payments. Relative valuation compares the asset to similar assets in the market using valuation multiples. Common ratios: price to earnings, or PE, price to book, or PB, enterprise value to EBITDA, or EV/EBITDA. Market-based valuation uses market prices and trading data to estimate value. Example: market capitalization, which is total outstanding shares times current stock price. Asset-based valuation values a company based on its net assets, which is assets minus liabilities, often used for liquidation or asset-heavy businesses. Examples: book value, which is net asset value from the balance sheet. Replacement value, which is the cost to replace all assets. Option-based valuation values investments with optionality, like startups or R&D projects, using models like Black-Scholes or binomial options pricing. Cash flows, consistent and predictable cash flows, lead to higher valuations. Growth rate. Higher growth rates generally result in higher valuations. Risk and discount rates. Riskier investments require higher discount rates, reducing their present value. Market conditions. Economic cycles, market sentiment, and industry trends affect valuations. Competitive position. Companies with strong market positions, brand value, or unique advantages are often valued higher. Management quality. Strong leadership and execution capabilities increase confidence in future performance. Enterprise value, or EV, is calculated as market cap plus debt minus cash. This metric is quite useful for comparing companies with different capital structures. The price to earnings, or PE ratio, measures how much investors are willing to pay per dollar of earnings. Meanwhile, the price to sales, or PS ratio, is particularly useful for valuing startups or companies with low profitability. EBITDA multiples normalized earnings by excluding interest, taxes, depreciation, and amortization. Lastly, the PEG ratio adjusts the PI ratio for growth, showing the valuation relative to growth potential. The top-down approach starts with macroeconomic trends and then narrows down to sectors and individual assets. On the other hand, the bottom-up approach focuses on the specific characteristics of the asset or company, such as financials, operations, and market position. Forecasting uncertainty is a significant challenge, as future revenues, cash flows, or growth rates are difficult to predict. Market volatility, with its rapid changes in market sentiment or conditions, can also affect valuation. Subjectivity is another issue, where different assumptions, like discount rates and growth rates, can lead to varied results. Finally, the lack of comparable data can be a problem, especially for unique companies or assets that may not have reliable peers for relative valuation. In investment, valuation helps determine intrinsic value versus market price to find undervalued or overvalued assets. For mergers and acquisitions, it's essential to assess whether a target company is worth its asking price. When it comes to startups, valuing early-stage companies often involves using projections, venture capital multiples, or options theory.